Despite the recent drop in the gold price, $10,000 an ounce is still in play by the end of this year, according to my guest today, James Rickards. He breaks down the main catalysts he sees driving the gold market, both fundamental and technical, along with unpacking why he thinks a financial crisis greater than 2008 is on the horizon, what it could do, where to be positioned before it happens, and where to look for bargains in the aftermath. All of this and so much more ahead. And sign up for the free Commodity Culture newsletter, readplaza.com/commodity culture. Link is in the description below. And now, James Rickards. James Rickards, great to have you back on Commodity Culture once again. I want to kick the conversation off with gold and silver markets as we see gold around 4,000, silver around 60, a fairly dramatic correction so far after both metals hit all-time highs in January, although they seem to be bouncing back somewhat today as we speak. I believe silver up close to 4%. Well, what are your thoughts on this recent price action? And is this a buy the dip opportunity or a time to exercise caution in your view?
I'll give you a longer explanation, Jesse, but the short answer is it is a really good entry point, buy the dip opportunity if you want to put it that way. Of course, I watch it closely, and you're right. End of January hit an all-time high. It was 53, 55. That was a closing price. You can get different numbers intraday depending on what ticker you look at, but call it 5,400 for a round number, but I think the ticker I use said 53, 55. It's down around 4,000 an ounce. It dipped a little bit below that. It was a three handle there for a while. It was like 3,900, 3,950, something like that. But you're right. It seems to have settled in around 4,000. So we all see the price action. The question is, what is this? Did we hit a peak and was that a bubble or a hyper spike? And now it's going to keep going down and, get out while the getting's good, et cetera. Or is this just how it goes? Is this a normal, I'll say normal, like not unexpected commodities price drawdown and a good setup for the next leg up to a much higher level? I am sure that it's the latter, that this is a drawdown, and it's where my target, my intermediate target, meaning late this year, early next year, $10,000 an ounce is still intact. Now, that's easy to say, but let me kind of look behind the curtain a little bit and kind of analyze that. The fundamentals have not changed. When I say fundamentals, uncertainty in the Persian Gulf, uncertainty in the war in Ukraine, central banks are still net buyers. China's buying hand over fist. Mining output is flat. I'm not saying peak gold in terms of mining, but when you have flattish supply and rising demand, that's a recipe for higher prices. And pardon me. We can all see what's going on with inflation. So none of those fundamentals have changed. So what did happen? Well, a couple of things. Number one, when the war in Iran broke out at the end of February, but you can kind of see it coming, they shut the Straits of Hormuz, and there was a time it was a double blockade. Iran was blockading the Straits, and the U.S. Navy was sitting out in the Arabian Sea. So Iran didn't let anybody through unless you were a friend of Iran or China and you paid a toll. But if you met those criteria and you got through, the U.S. Navy was waiting outside to board your vessel, blow you up, and turn you around. So how many people in the world were friends of both? The answer is nobody. You were either pro-Iranian, then the Navy stopped you, or you were anti-Iranian, and the Iranians stopped you. So it really was shut off. And I don't have to recite all the statistics. We all, 20% of the world's oil, 20% of the world's liquid natural gas, the larger percentage of the sulfur. People are like, what the heck is sulfur? I mean, they know what it is, but like, why is that so important? It's a precursor chemical in just about every important chemical process you can think of. And then also a major source of helium. Like, yeah, you blow up party balloons. No, yes, but you need helium to make semiconductors. So, and then aluminum, and then nitrogen, nitrates to make fertilizer to feed the world. The implications of this are mind-boggling. Again, people have been through that for the last couple of months. Some vessels are getting through right now. But not that many. Even on a good day, it's less than half the prior traffic. So the idea that, the coast is clear is just not true. Now, what does that have to do with the price of gold? The world needs oil. Now, there is oil around. The U.S. is not going to run out of oil. We have seen higher prices. We're not immune from a world price, But we're a net exporter. We get plenty of oil. We've taken over the Venezuelan oil. We're good friends with Guyana, right next door to Venezuela. They might have larger reserves than Venezuela, for all we know. So we're still exploring that. We kicked the Chinese out of the Panama Canal, and Trump's opening up leasing opportunities for oil and natural gas on federal lands, the Gulf of America, Alaska, and elsewhere. So the U.S. is not going to run out of oil. Neither is Russia, but they don't have enough to supply what's missing from the Persian Gulf. So will we send some to Japan because they're friends of ours? Yeah, but what does that do for Malaysia and India and in Africa and Europe, for that matter, and other places? The answer is not much. Russia could supply all the natural gas Europe needs, but the Europeans just seem to be intent on economic suicide, basically cutting off the Russians for no good reason. So again, how does that affect gold? Well, the answer is all of those commodities I just described are priced in dollars. They just are. And if you want those commodities and they're in short supply and the price is going up, you need dollars, and the price goes up more, you need more dollars. Well, how do you get dollars? Well, one way to do it is to sell gold and get dollars. So that created the downward pressure. In other words, countries, I said central banks are net buyers, and they are, but some countries, including Turkey, Russia to some extent, China and others, sold gold to get dollars to buy oil. So the downward price pressure on gold had nothing to do with inflation and monetary allocations and long-term trends, all the things we were just talking about. It had everything to do with the fact that the world was short of dollars and needed them, and one way to get them quickly, because it's liquid, is to sell gold. So that starts the downward price pressure. Then it feeds on itself. So all of a sudden, leverage traders are hitting stop losses, so they're selling, and the commodity trading advisors, they just love trends. They don't care if it's soybeans or gold. They're like, hey, it's going down, sell more. And then you hit more stop losses. It feeds on itself, and it keeps going down. So the trigger was the dollar shortage. So it was sell gold, get dollars to buy oil because you need the oil. And then the momentum continued for the reasons I mentioned, which is stop losses and just, momentum traders. Okay, so we are where we are. But all that's beginning to run its course. The war in Iran may continue, probably will, but some oil is getting out. Other suppliers have increased their output. Oil prices have dropped from, as much as $110 a barrel down to around 70, 67 when I looked this morning at some of the tickers. So that urgency about getting the dollars is diminished. Number one, some oil is getting out, not enough, but it's getting out. So a lot of that pressure is off. And I go back to something that Jim Rogers told me, it was 8 or 9 years ago. But Jim Rogers, probably the most famous commodity trader of all time, partners with George Soros in the launch of the Quantum Fund, and Jim has had a great career, kind of really a legendary figure. He told me, because this was in gold peaked. The last peak was 2011, August 2011. Gold peaked around $1,900 an ounce. Then it went all the way down to 1050, December 2015, 1050. So it was somewhere in that, kind of closer to around 2014 or so when we talked. And gold was going down pretty significantly. And we were in the Dominican Republic having a drink. And I said, Jim, what do you think? And he said, well, I'm holding gold. I'm not selling any. And what he said to me, I'll never forget. He said, in commodities trading, nothing goes to the moon without a 50% drawdown along the way. And if you're not ready for that, you're in the wrong market. Just get used to it. That's how commodities trade. Well, sure enough, now when you say 50% drawdown, you have to pick a base. So if you do the math, I took a base of $250 an ounce. That was the low in 1999. That was like the post 1980 low was 1999, $250 an ounce. So I took that as my base, went up to $1,900. So as the peak. Divided by 2, took that, subtracted from 1900. Guess what I came out with? 1070. Guess where it bottomed? 1050. In other words, Rogers was like right on the money. Not surprising because he gets this. Now, not to get too geeky, but there's something as a branch of mathematics called fractal mathematics, and it has a principle called scale invariance. What does that mean? It means if you take a 1 week chart of the stock market and put it next to a 10-year chart, but take out the dates, they look the same. In other words, these patterns repeat at different scales, but it's the same pattern. So taking what Jim Rogers taught me, applying scale invariance, and looking at today's market, now we need a new base because I was using, I think, around $1,800 an ounce up to the 53.55. Take the 50% of the difference, subtract it from 53.55. You come out around 3,600. So in other words, I'm not saying the gold is going to go to 3,600. I am saying it wouldn't shock me if it did. But the importance of that is it's the same pattern that Rogers described to me. It's the same pattern we saw from 2011 to 2015, a little more compressed, but that's okay because, as I say, scale invariance means it's the same thing in a shorter time frame. So on a fundamental basis, which we talked about, central bank buying, flat mining output, inflation concerns, uncertainty, et cetera, gold should go up. But even on a more technical basis, and I'm not a technical analyst, but I do understand fractal math, but using the Jim Rogers rule, a 50% drawdown from 53.55 should not be surprising. Well, we're there. So I think this is played out in unsurprising ways. But the other side of that is we're ready for the next stage of the liftoff. So, yeah, I think it's a very good entry point.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Excellent breakdown. And one of the main catalysts a lot of people have been looking at recently is the fact that gold officially surpassed U.S. Treasuries as the most widely held reserve asset. This was originally reported at the end of 2025. The ECB recently released a report that brought it back into the spotlight. What is this telling us about gold's role in the monetary system? And do you think these central banks stacking gold know something is coming ahead, a monetary reset of some kind? Are they simply removing wealth from counterparty risk? A lot of people point to the U.S. and its allies freezing Russia's FX reserves as a big catalyst for governments around the world to kind of wake up and realize, hey, we need an asset that has no liability or counterparty risk. What are your thoughts on this development?
Well, Jesse, you're right about the fact that gold surpassed U.S. Treasuries U.S. dollar denominated assets as a percentage of global reserves. That's just a fact. But it's important to know why. It wasn't the case. Again, central banks are net buyers. I want to be clear about that. That's been true since 2010. But it was not the case that they just dumped treasuries and bought gold, and that's why gold went up. What happened was they had a certain amount of gold, they had a certain amount of treasuries. Treasuries, they can be volatile, but they don't move around that much in price. But gold was more than doubling. It was almost tripling in a fairly short period of time. So, and they were adding gold, but even with the same quantity of gold, if you triple the price, then in dollar terms, it's going to be a bigger percentage of total assets. So yes, gold did surpass treasuries as a percentage of total reserve assets, but it wasn't so much because they were buying enormous amounts of gold. They were buying some. It was because the price tripled, and that's what happened. It's like any portfolio. When you have a winner like that, it's like, it feels good, but you might have to reallocate your portfolio a little bit. So yes, gold surpassed treasuries, but the reason was because the price tripled, not because they bought so much more gold. Now, having said that, it begs the question, well, why are they buying this gold? And that's kind of what you pointed to. Do they see something coming? I think it's already here. And what it is, this goes back to 2022 and the Russian special military operation in Ukraine. And it's here we are, 2026. That war is more than 4 years old. It's not going to be over for maybe another year, but it's been a pretty brutal struggle. Russia is winning. They're going to win, but they're in the process of winning. That's very clear. I know that Ukrainians are sending drones to Moscow, but yeah. Okay, a little damage, but not that much actually. Um, but what's going on there is that Russia had $300 billion of U.S. Treasury securities in its reserve position prior to the outbreak of the war. And this is the work of Vera Nabiulina, who's the head of the Central Bank of Russia. I always say she's the only central banker in the world who understands her job. She's actually pretty good at it. But if you go back to, I'll just say January 2022, before the war, the Russian reserve position was approximately $600 billion. Of that, $150 billion, or 25%, was in gold, physical gold bullion in Moscow. We're not talking about tokens or futures or anything else. They had the gold in Russia. But they also had about $300 billion in treasuries. And then the rest was in, some euros and some other assets. So but what do you do with $300 billion of treasuries? Well, the last printed treasury bond was issued in 1979. People talk about digital, crypto, all this stuff. The treasury market has been digitized and with encrypted message traffic since 1979. So it might be the original cryptocurrency. But when you have that, you're talking about a digital ledger. Okay, who controls the ledger? Well, now you need a custodian. The ultimate control is with the United States Treasury and the Federal Reserve and FedWire. The Federal Reserve acts as fiscal agent for the Treasury, so they control it. But in between, you have custodians like Euroclear and Citadel and DTC and others. Well, the Russians had about 200 billion out of their 300 billion in custody at Euroclear in Belgium. Because why? They trusted the Belgians, they trusted the Americans. Big mistake. So what happened was the U.S. and Europe together froze those assets. So they're still there. Actually, I say they're still there. They have matured because a lot of them were short term. So that when they mature, the Treasury just gives you cash. I don't know that they've been reinvested in U.S. Treasury securities, but whether it's cash or Treasuries, it's U.S. dollar assets, and they're on deposit in Euroclear, but they've been frozen. Russia can't get them. Now, the U.S. freezes stuff all the time. We're really good at it. Syria, Iran, North Korea, anybody we don't like that day, we can freeze your assets. But stealing them, seizing the assets, not just freezing them, is a completely different thing. You get into all kinds of legalities, et cetera. Well, Europe and the United States were moving to seize the assets, actually steal them from the Russians. And the rest of the world looked at that. And by the way, they've come up with the most cockamamie schemes. The one idea was Europe would issue bonds and then give the money to Ukraine as a loan. And then Ukraine would pay the loan back with reparations after Russia lost the war. But if it didn't, the loan would be collateralized by the Russian assets. That was the idea. Everything I said is true, but it's all not happening. Like, Russia's not going to lose the war. They're not going to pay reparations. The loan's going to go into default. And one way or another, they're trying to steal those assets. Now, here's the point. Let's say you're Saudi Arabia or China or Japan or South Korea or Taiwan or a lot of other countries around the world, and you have 300 billion, 500 billion, $1 trillion in U.S. Treasury securities and in custody the same way as the Russians, and you watch what we're doing to the Russians. What do you say to yourself? You say, hey, what if America wakes up one day and doesn't like what I'm doing? Or they don't like my foreign policy, et cetera? Are they going to steal my treasury assets? Well, the answer is maybe yes. I mean, if they do it to the Russians, well, you get on the bad list, maybe they'll do it to you. And so you start to hedge. You start to buy gold. And that's part of what's driving not the only thing, that's part of what's driving the central bank movement to gold. It's inflation, yeah, but more, it has more to do with an asset that the United States can't steal. Because if you buy physical bullion and put it in your own vaults, don't leave it in the Federal Reserve Bank in New York or the Bank of England in terms of vaulting. Put it in your own vaults, and it's physical. It's not digital. You can't hack into it. You got to invade the country if you want to go that far. But the point is, it's geopolitically safe. It's not just about inflation and diversification. Yes, those things count, but physical bullion is safe from the U.S. stealing your U.S. Treasury. So I would say the U.S. which had a reputation as a good rule of law jurisdiction, has diluted or tarnished its reputation and given other countries a reason to own gold. So I always say if it's good enough for central bankers, it's good enough for me.
You mentioned recently on an interview that we're getting close to the point of a financial crisis becoming bigger than the Fed. Could you unpack what you mean by that? And ultimately, is excessive Fed and government intervention in the economy and financial markets going to worsen a potential crisis up ahead?
Well, I say in terms of financial crises, I've been around long enough. I say if I wasn't there, it didn't happen. I go back to 1974 with the failure of Bank Herstatt in Germany. Early 1980s with the the Argentina, Brazil, Chile, the so-called ABC banking default, insolvent banking. 1987, the Dow falls 22% in one day. It wasn't not a month or a year, one day. That would be the equivalent of let's see, about 15,000 points in one day. That's what happened. 1994, the tequila crisis. 1998, long-term capital management. Russia crisis. I negotiated the bailout. I was the lead lawyer for LTCM, opposing 140 lawyers from 14 Wall Street banks. And then the 2008 financial crisis, I was an advisor to the McCain campaign. I was on one call. It was in late August. It was after the U.S. government bailed out Fannie and Freddie, and the McCain team said, "Great, the crisis is over. Now we can talk about the war in Iraq," because that's what McCain wanted to talk about. And I said, pretty, John Taylor and other people were on the call. And I said, sorry, guys, the crisis is not over. You are not going to make it to election day without this thing getting much worse. You could see the dominoes falling, and I'll say everyone, at least some of us knew that Lehman was the next one to fall. I said, the crisis is not over. You need to prepare now, have a speech ready, get your guy on the steps of the Treasury with a 4-point plan. Just make up the points. It doesn't matter. The American people are going to want to be reassured. I was not invited back. Then the crisis came, and McCain ran around with like a chicken with his head off. Obama didn't actually know any better, but he was smart enough to keep his mouth shut. And then McCain said, I want a meeting at the White House. And Bush said, well, if I invite McCain, I got to invite Obama because, there's an election going on. And they did. And Obama came off looking very calm and cool. Even I'm not saying he's an expert. I'm just saying he played it cool. McCain looked scary. That was the day, the Lehman Brothers weekend, and then the White House meeting. That's when the polls crossed. McCain was leading in the polls up until then. And then Obama went ahead, McCain went down and never looked back. So maybe they should listen to me in terms of winning the election. But my point is I've been through it all. I wrote a book in 2019. I predicted the COVID crisis. That was my book, Aftermath. So what are we looking at now? What I've seen the Fed bailouts. LTCM, interestingly, the money came from Wall Street. The Fed orchestrated it, just to be clear about that. But we were like, hey, we're not a bank. We're a hedge fund. But even in 2008, Morgan Stanley and Goldman Sachs were just days away from failing. I mean, the dominoes were still falling. Lehman, yeah, but Morgan Stanley was going to be next. And the Fed turned them into bank holding companies in less than 48 hours. Now, I've done Fed applications that took 2 years because they didn't like what we were trying to do and they just dragged their feet. Okay. This was like 2 days. Hey, boom, you're like a magic wand. Hey, you're a bank holding company. And then the Fed bailed them out. So, but as recently as 2023, we had Silicon Valley Bank. Now, what happened there? So on a Friday night, I think this was in May. I got to check the exact dates, but on a Friday night, the FDIC issued a press release and said Silicon Valley Bank is being taken over by the FDIC, and we're only paying insured deposits, which is $250,000 per person. You can have husband and wife can have multiple accounts, whatever, but low six-figure insurance. We're only paying that. Everybody else, if your deposit is higher than that, we're going to give you a certificate and we'll get back to you in terms of what it's worth. We got to look at the assets, figure out the bad assets, have a fire sale, whatever, get some money, do a pro rata, but we'll get back to you on that. Well, that weekend, I call it the billionaire crybabies came out in force. This guy, one of the big hedge fund guys, they're all banging on the White House saying, you don't understand, Silicon Valley go bankrupt. There are all these startups. They got $3 million at Silicon Valley Bank. That's their working capital. They can't pay the rent. They're going to have to lay people off. They ignore the fact that 95% of these firms fail anyway, with or without a financial crisis. But they basically, Bill Ackman is the name I was trying to think of. He was one of the big crybabies, but there were others. Anyway, they said to the White House, you're going to shut down Silicon Valley and all these wonderful startups if you don't do something. So they did. And so Sunday night, before the market opened the next day, the FDIC came out and said, just kidding. All the deposits are insured, unlimited amounts, no problem. And then the Treasury said, the Federal Reserve said, hey, all you banks, all you other banks, some of them, upwards of $1 trillion of assets or 900 billion or whatever, who have Treasury securities. And by the way, at this point, because interest rates have been going up and so many banks bought Treasury securities with a yield to maturity of like 1.5%, 2%, because that's where the rates had been earlier, those securities were only worth 70 cents on the dollar. Well, that's what, rates go up, prices go down. It's that simple. So the Fed said, send us your Treasury securities. We'll give you par. So it's worth 70 cents on the dollar, but we'll give you 100 cents on the dollar as a 1-year loan, and then, low interest, and then pay us back a year from now. But meanwhile, don't worry about it. So the Fed basically guaranteed every Treasury security in the system at par value, even though they were worth 70 cents on the dollar. And the FDIC guaranteed every bank deposit in the system, regardless of the deposit insurance limit, which was only $250,000. And by the way, there were some crypto exchanges that had multi-billion-dollar accounts at Silicon Valley Bank, and Cisco was not a crypto exchange, but they had that kind of amount of deposits. So I looked at that and I thought to myself, okay, Fed and Treasury and FDIC, you just guaranteed every Treasury security in the country owned by a bank, and you just guaranteed every deposit in the country, regardless of insurance. What else have you got? Meaning, your guarantees can't get any bigger than that when you guarantee all the deposits and all the treasuries. So then I said, well, what happens when the next crisis hits? What other rabbits can you pull out of the hat? And just to summarize, Jesse, yes, there have been a series of bailouts. I've seen them all going back 40, 45 years at this point, maybe longer. But each bailout is bigger than the one before. And does there come a time when the crisis is bigger than the Fed, when the Fed bailout doesn't get you anywhere because it's already been priced in and this thing is really out of control? I think we're at that point. And it's one more reason to own gold.
And what does that crisis, as it eventually arrives, mean for both Wall Street and Main Street, in your view? Are we looking at something akin to 2008? Is this going to be worse? And which asset categories do you think will suffer the most in the aftermath? And where would you see potential opportunity and perhaps picking up the pieces after a massive correction like that?
Possibly worse. And the reason I say that is because 2008 turned into a global financial crisis, but as we all recall, it started in the subprime mortgage market. There were $1 trillion of subprime and so-called Alt-A mortgages. And a lot of people said, well, we could have 20% losses. It's only 200 billion. What's the big deal? What they ignored was that there were 5 trillion of derivatives piled on top of the 1 trillion of junk mortgages. And that's what got, AIG Financial Products and Goldman and everyone else in pretty deep trouble. But it was huge, and we got the Treasury and the Fed involved, et cetera. But now we're seeing it in multiple dimensions. There is a global dollar shortage, and people say, how could that possibly be with all the Fed money printing? But the Fed money printing is sterilized because the Fed prints money by buying Treasury securities. So the Goldman and Morgan Stanley deliver the Treasuries to the Fed, and then the Fed gives them cash that comes out of thin air. Okay, that's money printing. But then they take the money and give it back to the Fed in the form of excess reserves. So all you're doing is inflating the balance sheet of the Fed on both sides. You're not creating money that does anything for the economy. It's not stimulus. That's nonsense. But But in terms of M1 and M2, there is a severe dollar shortage. And that goes back to what we said earlier about selling gold for dollars because to buy oil because you're short of oil and dollars. So that's a problem. But we have a huge crisis in private credit. Now, private credit is just old wine in new bottles, as they say. It's just the junk bond market. But instead of junk bonds and Mike Milken and Rodeo Drive and all that stuff in the 1980s, what we have are funds that invest in loans basically to junk credits. We've seen some big bankruptcies at Tricolor and a couple, instead of subprime mortgages, subprime auto loans, but it's not limited to that. Massive, $100 billion and more loan portfolios to these hyperscalers and AI data center builders, et cetera. And all of that is collapsing. Now, because they're funds, you don't actually see some of the borrowers have gone bankrupt, but you don't actually see the distress because it's boxed into the fund. What happens is the investors gave notice to the fund managers, who are the biggest names. It's KKR, BlackRock, Blackstone, and others. Apollo. Again, these are the biggest names in the industry, saying, "I want my money back," and the managers put up gates, and they say no. And I've written scores of private offering documents, and I've read hundreds, so I know what's in the fine print. But it starts out, here's what we do, and here's how much money we're going to make, and here's this notice periods and how you get your money back. And somewhere around page 50 in fine print, it says, "Oh, by the way, if there's a market distress or disorderly markets in our sole discretion, we reserve the right to not give you your money back." People usually gloss over that, but it's there, and that's what they're doing. So now people are saying, "Give me my, whatever 500 million back," and the managers are saying, "You can have 5%. Here's 2.5 million, but we're keeping the other, whatever 497.50 million, and we'll get back to you." And that's what they're doing. So now that doesn't mean it's all good on the asset side. The assets are collapsing, but nobody wants to mark them to market because then the accountants get involved and they say, "Hey, this guy just marked this thing down. You own the same thing. You got to mark it down. Why is your value down?" And then the whole thing implodes. So right now, everyone's holding their breath, walking on eggshells, and pretending there's nothing wrong, but there's a serious problem there. And then, but I keep going, and then we've got the wars we talked about, an escalation. So looking at the price of oil, the Persian Gulf, Ukraine, private credit, dollar shortage, over leverage, an AI bubble. I'm not against AI. I wrote a book about it, but I see 4 or 5 different stress points or bubbles all at the same time, not just one. Any one of them could cause a crisis, but you combine them, you're talking about, I hate to use cliches, but the mother of all financial crises.
And so, given everything we've discussed so far today, how would you approach portfolio construction in the current market environment? Would you be heavy in cash in anticipation of a large drawdown in the broad market, which would hit all sorts of other sectors as well? Do you think there's areas of the market that prevent an attractive value proposition regardless? Would love to hear your thoughts there.
Sure. I'd have 10% in gold. We don't have to revisit that. We talked about that at the beginning of the interview. So I'd have 10% in gold, not 50%, but 10% is a nice slice. I'd have 30% in cash. That's a big allocation, but people say, well, cash has a pretty low yield. Well, it's actually higher than it used to be, but that's not the point. Cash has embedded optionality, meaning you have an at the money call on every asset class in the world. When things collapse, you're the one who can go shopping instead of selling assets because you're in distress. You're the one who can go shopping for the bargain. So, and also cash, don't rule out deflation. We talked about inflation, but so cash is a very robust asset that gives you a lot of optionality. I like real estate, not downtown commercial real estate, but farms, income producing real estate, residential real estate. That'll do well. Treasury notes, I think interest rates are going to come down a lot. They may go up a little before they come down, but rather than pick an exact top, you don't need to do that. Depending on your appetite for volatility, shoot in 10-year notes, 5-year notes, 2-year notes, et cetera. When interest rates come down to the 1%, 2% level, which I expect, you're going to have really nice capital gains on those, and they're safe and liquid, assuming you're not Russia. So that's a good asset class. In terms of stock market, I would lighten up. You don't have to get out completely. I would get out of AI. I'd get out of hyperscalers, get out of software, and some other sectors I like. Defense is going to do well, and healthcare. I look at we all look at employment statistics, and a lot of them break. Here are the job gains, job losses, and they break it down by category, et cetera. For job gains, healthcare is always number one. It's not technology. Technology is up there. Other manufacturing, other service occupations, chambermaids, baristas, whatever. Some of those categories are pretty high, but healthcare is always number one, and that's for a lot of reasons. But one of them is demographics. I mean, the oldest baby boomer is turning 80 this year. Happy birthday! But the correlation between that and a whole, an 80 million people, well, it's declining now, but 80 million baby boomers approaching their 70s and going into the 80s with, sad to say, Alzheimer's, Parkinson's, dementia, heart attacks, and more. And then the healthcare providers, could be in their 30s or 40s or whatever, but they are, I can tell you from personal experience, they are so in demand. And the talented ones can get jobs in a heartbeat. So I like that sector. Oh, sorry. I should also mention energy. The Chevron's ExxonMobil. So energy, defense, healthcare. I like natural resources, mining, minerals, agriculture. I'd be out of AI, hyperscalers, software, and whatever else is associated with the bubble.
Okay, great. Yeah, I was going to follow up on gold and silver miners. It sounds like that's an area of the market that you're also bullish on right now. I want to talk about a company that you're working with right now because AI, we talked about AI a little bit. You've got a whole book about AI Money GPT, which I recommend people check out as well. But AI is also making phone scams more convincing, unfortunately, with voice cloning, sophisticated impersonation schemes. You've become involved with Call Fort. This is a company focused on stopping scam and spam calls before they reach consumers. Walk us through that for us.
Yeah, thanks. Thanks for asking, Jesse. This is a company called Call Fort. It's spelled like it sounds, CALLFORT, one word. Call Fort. It's an application. It's actually out there. This is not the pitch book stage. I mean, it's real. It's available on the iStore, the Apple Store. You can go to it and download it. It's very inexpensive. Yeah, I know it very well. I was an early investor in the company. And I said to the founder, I said, look, I'll invest in this company on one condition, which is I want to be your first customer because these spam calls are driving me crazy. Now, I've got a couple phones, iPhone, Samsung, whatever. I got a couple different carriers. So I'm on AT&T and Verizon and all that. And they have a kind of spam alert. They say this call looks like spam. Okay, but they don't stop it. It still rings. And I'm in a position, I can't hide my phone to be without it. I'm kind of on call and I have to be available. So, at all times. And so when the phone rings, if I'm in the next room, I got to go get it because it could be something important, but it's spam. So even though it's telling me spam, I'm like, hey, it still rings. It's still annoying. I'm still filling up my inbox or call list. It was really a mess. Call for it fixes that. And it's an amazing tool. First of all, it uses artificial intelligence. It's not just that it is a spam blocker, but it's not just that. Because they have a customer base and because they're using AI, they can look through the message traffic and say, hey, over here is, Mr. A, he got a spam call. Well, here's Ms. B. She's getting a call from the same number or the same set of numbers because it actually goes on offense and penetrates the spam networks. So we're going to block it on her phone because we already know it's spam because this guy over here called it spam. Now, you can have a whitelist. So your contacts are your whitelist. Those calls will come through. If you're calling other people, that just goes on the whitelist because they're like, well, you wouldn't be calling spam. If you're calling somebody, that must be a call you want. It knows other, I'll say white hats or good callers. Again, from this AI application database, it does a really good job of that and does a really good job not just blocking the spam. It does do that, but it doesn't even ring. It doesn't even get through. And there's a simple algorithm it uses to, if it's on the whitelist, it just comes through. If it's unknown but not to be known spam, there's a simple challenge which anyone can do, and the call goes through, but the robots can't do the challenge, so they get, then it goes to voicemail. Not to be long-winded, this is unbelievable, and I'll just say it's made my life better. I mean, I can talk about the AI and the technology behind it all day, and it works extremely well. But it's my test is, did this make my life better? Some applications make it more complicated, or they're hard to work with, or whatever. Maybe they're just okay. This one has actually improved the quality of my life. Very modestly priced, very affordable. It's just a couple bucks a month, and I would say just go get it and download it and give it a try. But I promise you, it not only works extremely well, better than most people expect, but actually will improve your life.
Well, I'm going to put a link to that in the description below. Before we close things out as well, I definitely want to mention a book I've been reading called The Entropy Trap by econophysicist Mickey Maney. You wrote the foreword to this book. It's been endorsed by some other big names out there, Christopher Whalen, Dr. Nomi Prince. And I can attest this is a fantastic book. They sent me a copy, an interesting look at how ideas from physics and complexity science actually can explain the way that markets behave. It sounds really complicated. I was worried about the physics and science side, but Mickey breaks it down in a very clear and easy to understand way. You wrote the foreword. What are some of your thoughts, maybe briefly before we close things out, about this model that Mickey's come up with?
Sure, it's a great book. It uses as its kind of foundation intellectually the second law of thermodynamics. And before people run away, like, oh, the second law of thermodynamics, how am I going to figure that out? It's a pretty simple law, which says that a complex system needs energy inputs. It just does. And capital markets are a complex system. That's what I do. By the way, I've been doing this for over 20 years. Complexity theory, fractal mathematics, Bayes theorem, kind of things we talked about earlier. But complex systems need energy inputs. But the problem is, as the system increases and grows in complexity, it needs more energy, but it's an exponential function. And what I mean by that is, if you double the size of the system, you don't double the energy input. You increase the energy input by a factor of 10. And then if you double it again, maybe a factor of 20, et cetera. In other words, the energy demands get exponentially larger as the system grows in complexity. And what happens when the energy runs out, one way or the other? The answer is the system collapses. So as a forecasting tool to study risk in capital markets in particular, but also complex systems, it's just good physics. This is a couple hundred years old, but the physics and the math are a couple hundred years old. But what's new is applying it to capital markets. This has been applied to natural systems and the sun and the origins of the universe and all that for a long time, and other physical systems. But applying it to capital markets is new. So that's what I've been doing. That's what Mickey Maney does in this book. Does a great job, but it is not a textbook. It is very, very readable, very enjoyable. It's got some vignettes of Jesse Livermore, Bernard Baruch, and Joseph P. Kennedy, three of the legendary investors of all time, except Jesse Livermore made one of the greatest fortunes in American history on the stock market crash, but he got back in too early and then lost it all because he got in when the market was, so he got back in when the market was down about 30 or 40%, but it actually went down 82%. So he lost what he made, kind of a sad ending, but a good lesson. Baruch got out in time, did not get back in early, but he didn't get back in on the upswing. So he didn't lose a lot of money, but he missed the opportunity to make a lot more. The guy who got it just right sold out before the crash, got back in at the bottom with Joseph P. Kennedy. So there's some really lively case histories side by side with the description I just gave. But this whole field, econophysics, applying physics and complexity science to economic systems is a big deal. Wall Street doesn't do it. I mean, I briefed the board of directors of Morgan Stanley. We talked about it. It's a nice group of people. James Gorman was the chairman at the time, but they're not doing it. And I have pretty good familiarity with the other firm, but you can do it. And you can learn a lot from this book, The Entropy Trap. And I wrote the introduction. The introduction is a synopsis of everything I just talked about, a little bit longer. And just suffice to say, I wouldn't have done that if I didn't think very highly of the book, and I do. The Entropy Trap.
I'm going to put a link to that in the description below as well. And finally, for people who want to follow your work, I know Money GPT's your latest book. I'll put a link to that in the description below as well. Is there anywhere else people can go online who want to follow along with you?
Sure. I'm on X at Real Jim Rickards. One word, at Real Jim Rickards, Rickards, all one word. And my flagship newsletter is Strategic Intelligence from Paradigm Press. If you just do Paradigm Press, Jim Rickards, Strategic Intelligence in your browser, you'll find it. And we put a lot into it. We have other publications, but that's our flagship, 12 issues a year, and hope people find it and enjoy it.
Great. Link to your X account as well as the newsletter will be in the description as well. James, as always, fantastic conversation. Thank you so much for coming on the show.
Thanks, Jesse.
Thank you for joining us today. Our sponsor, ARC Silver Gold. Osmium has some great prices on precious metals, bullion products. You can see some of them on your screen right now. These are subject to change and while supplies last, so reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. Make sure, of course, to tell him that Commodity Culture sent you and sign up for the free Commodity Culture newsletter. readplaza.com/commodity culture. The link is in the description. I break down the various interviews and episodes that I do on this program in a way that provides the most actionable information we can all apply to our own investment decisions. Sign up today, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.